I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm the host today for Financially Speaking with Jeff Bush. Today's topic is wealth accumulation with a focus around retirement planning. So with that said, Jeff?
Well, hello, Steve. Welcome to the show. Great to be here. So the topic of our show is timely today because this is really tax season. People are filing taxes and thinking about ways that they can save money through investing. So we're going to go through some of the different vehicles that are available to you, and we'll see if we can maybe uncover some opportunities for those that are watching us.
Oh, good. And Jeff, before we really get started with this, we've had many of your team in the news. Can you tell us a little bit about that?
Yeah, so in the news, so we've had the good fortune over the course of the past year to be featured in a number of publications. Of course, you were featured in the Norristown Patch. Our colleague Barry was in Investopedia and Yahoo News, and I wrote an article for the Reading Eagle, and I was also interviewed for an article in the U.S. News and World Report. So we've had the good fortune of getting some good press, some good exposure, in addition to what we're getting right here on PCTV.
Yep. And if we go back to locations, how long have you been there? How long have you been doing this program?
Well, we've been doing the show, Financially Speaking, now for this is our we're into our 5th year, believe it or not. Boy, time flies when you're having fun. Right here in Pottstown, and of course the reason why we are doing this, in addition to getting all this wonderful exposure here on PCTV, the show is streamed on the PCTV network website, which is thepctvnetwork.com, and of course we put it on our website too, informedfamily.com. So we get a lot of exposure from that. Our firm, Informed Family, has been around since 2001, so a long time. And we have offices in Norristown, and of course we have an office right here in Pottstown, right there on 152 East High Street, which is right on the corner of, right in the hustle and bustle of Pottstown, the corner of High and Hanover Street.
Now let's get into the topic a little deeper today. I think the one that the plan that everybody recognizes and knows a little bit about are 401s and the 401k world.
Yeah, I mean, the 401k is, I think it's one of the greatest inventions in the history of investing. The reason for that is that it's a way to accumulate wealth at your place of employment. The money is taken right out of your paycheck, it goes right into an investment within your 401k. It's matched frequently by your employer at some ratio. So, for example, maybe you're putting in 6% of your paycheck, and your employer is matching it maybe at 50%, so they're putting in 3%. So that's an instant 50% return on your money. So, you'd be foolish not to take advantage of that. So, and I'm a big believer in, saving and investing periodically. So it's really a great thing. And the tax savings, of course, are the real benefit of this, because it's taken right off of it's done with pre-tax dollars, so you're not taxed on that money that you're putting in.
So it lowers your taxable income.
It lowers your taxable income. So if you're putting in 6% of your income into a 401k, then that means you're being taxed on 94% of your salary instead of 100% of your salary. So it gives you a tax break.
Okay. And what are some the type of investments that would be in something like a 401k?
They're typically, well, it could be your company stock.
Okay.
So, like if you work for a large corporation and the corporation is publicly held, your company stock could be in there. But generally, it's mutual funds, stock funds, all kinds of stock funds, bond funds. What's been popular within the last several years are these target funds.
Yep.
Target is they target a specific retirement date. So let's say you're going to retire in the year 2025. So let's say right now maybe you're 55. Okay, so you pick a target 2025. So that's like an estimate date of when you're going to retire. So you can put the money into this target fund, and then the risk of that fund is adjusted as we get closer to that time. So, like, right now as we sit here today, you're 7 years away. So we're starting to get that portfolio a little more conservative, a little more ready for retirement. I want to get back to the company stock option, though, because we're a little nervous about putting too much money into the company stock just because of risk. And of course, everybody well, maybe not everybody knows, but many years ago, there was a case in a company called Enron, which was an energy company in Texas, where the company actually, it was a big company, and then all of a sudden it went belly up, and all the employees had all this stock in their 401k. And I believe what Enron was doing when they were matching with stock. So there's been some regulations since then, but it's great. You work for a company and you love the company and you want to buy the stock. That's a great thing. Just be careful with the proportion of which you do that.
And Jeff, for years and years and years, you could never take money out of your 401k without it being taxed or a penalty until you left your job. And that playing field's changed now. So and a lot of people don't know about it.
Yeah, so there's a few things that you can do with that, Steve. So one thing is when you reach the age of 59 and a half, 59 and a half is kind of like a magical number, because that's when the IRS lets you take money out of a qualified plan and you don't incur a penalty.
Okay.
So a lot of these 401k plans are written so that you can do in-service distributions. So you can either take that money out and spend it and not be penalized, or you can roll it over into another IRA. Okay, so that's one option. The other option is doing what's called a 72T.
Yep.
So and they get the term 72T. That's the IRS code that allows you to do that, 72T.
Yeah.
And what a 72T does is it allows you to take what they call substantially equal payments from a 401k plan, and you're in or an IRA, and you're in essence taking distribution before you're 59 and a half. So this is popular if let's say you're in your 50s and you retire. So we've seen that a lot. A lot of times with big companies, they're looking to cut staff, or for whatever reason you're out of a job and you're not 59 and a half yet. So you can use the 72T to take these distributions from your retirement plan without being penalized.
And a 401k is for companies that make a profit. What are some of the other tools that are out there?
So there's a 403b, which is the sister to the 401k, and a 403b, for all intents and purposes, and for our discussion here today, it's the same thing. It's just there for nonprofits, schools, universities, charities. It's in essence, it's the same thing. You're putting money in, you're putting it in on a tax deferred basis, and a lot of times the institution is matching those numbers as well.
Okay. And so those are if you're employed by a company, or employed by maybe the government or school system. What about people that are maybe self-employed?
Well, if you're self-employed,
or you don't have one of those programs.
Yeah.
Yeah.
So you don't have a 401k available to you. So there's the IRA. Almost everybody's heard of an IRA. So an IRA, it stands for Individual Retirement Account. And these were, I guess the IRA goes back to, it's hard to keep track of all this tax legislation, but it goes back to the 80s, I believe. Used to be, you could open up an IRA account and put $2,000 a year into it. Okay, but the IRA is a good thing to have if you don't have a 401k, or maybe you do have a 401k but you qualify from an income standpoint, or maybe you want to put money in for a spouse. They have spousal IRAs, so you could, the spouse doesn't even have to be working and have income. So the IRA is good, and of course, the IRA is also the vehicle that we use when we're doing rollovers out of the 401k, out of the 403b, out of these other qualified retirement plans. You can put them right into an IRA.
Okay. And let's talk a little bit about how it's taxed, how the money coming out is taxed, and is there any point where you have to take money out of an IRA?
Yeah. So the taxes on it. In essence, what you're doing with a traditional IRA is you're getting a tax break up front. So you're putting money into the 401k, you're not paying taxes on that money. It remains tax deferred until you take a distribution. Then you're taxed on the entire amount. If your employer is making some kind of a match, they get a tax break, a corporate tax break for making that match.
Yep.
So in essence, that money that's going into your 401k account, that match, that's also tax deferred.
Yep.
So in essence, you're building up a great big, you could say you're building a tax time bomb, because the good news is you're growing money, you're
Sure.
saving for retirement. The bad news is, or it could be, that you're building up a tax liability. So you're going to pay taxes on that money. So, and yes, your other question is, do you have to take a distribution? When you're 70 and a half, the IRS requires you to take a required minimum distribution, or what we all refer to in the business as an RMD. So you have to take an RMD when you're 70 and a half. You have to start taking a distribution from your retirement account. It's based on a formula. It's based on your age.
Yep.
And you have to take that money out and pay tax on it. So the theory there is that the IRS is allowing you to defer income and defer taxes on that account only for so long. Once you reach the age of 70 and a half, then they are forcing you to take a portion out. So that first year, again, it's based on a formula, but the first year you're taking out a little less than 4% and paying taxes on it. And then you're going to be required to do that every year for the rest of your life. Now, if you don't, so if you were going to ask me, well, what happens if you don't do it? What happens if you miss it? You don't want to miss it. The penalty is pretty severe for missing a distribution on an IRA. 50% penalty for missing a distribution on your IRA. So if you were supposed to take a $4,000 distribution on an IRA account, you're going to pay a 50% penalty. You're going to pay a $2,000 penalty for missing an RMD. So you don't want to miss it.
Right.
And of course, at our firm, we go to great lengths to make sure that doesn't happen.
Yep.
Okay, so we're meeting with our clients. They're over 70 and a half. We have a computer that we know how old our clients are. Most of these accounts that our clients have retirement money in, they're getting letters from these custodians too, saying, hey, you're 70 and a half, you have to take your distribution by December 31st. So there's a lot of safeguards in our system. But ultimately, it's the responsibility of the taxpayer.
Yep.
It always falls on the responsibility of the taxpayer to make sure that you take these minimum distributions.
And so we talked about pre-tax accounts and saving vehicles. What about maybe after-tax vehicles?
Yeah, so that's a good question. So there's the Roth IRA, and now there's the Roth 401k. So we'll talk a little bit about that and the timing of that. So the Roth IRA has been around for a little over 20 years now. 1997, the Roth IRA. I know, time flies. It's hard to believe. Yeah, so the Roth IRA has been around now since 1997. Hard to believe. But the Roth IRA is a good alternative to the traditional IRA, because the traditional IRA, you're getting your tax break on the front end. You make a contribution, you get a deduction on your tax return, and that's the tax break. And then all the money grows tax deferred in that account until you take a distribution. The Roth IRA, it's working exactly the opposite, meaning that when you put money into a Roth IRA, you don't get any kind of tax break. And then all the money in the account is growing tax-free. So you're getting a tax-free. It's one of the few things, Steve, in our tax code that allows for tax-free growth.
Wow.
Okay, so you're getting tax-free growth, and not only that, you're getting tax-free growth over, I call it 2 generations, because you're getting it over your lifetime and the lifetime of your spouse if you're married. And then you name your children as beneficiaries, and then when you die, it goes to them, and they get tax-free growth over their life. So if you're in your 50s or 60s and you have children that are in their 20s or 30s, the life expectancy of somebody who's 25, they're going to live another 65 years. So you're getting 65 years of tax-free growth. Now, it's not quite that simple. There's minimum distributions that are required when it's inherited by your child, but still you're getting tax-free growth. Now, there's also the Roth 401k. That's fairly new. That came out with tax legislation back in 2010. A lot of people don't even know about it. There's people that don't know that you can contribute in a 401k just like you would do a Roth. In other words, in a traditional 401k, you put your money in, you get a tax break. With a Roth 401k, you're putting money into the Roth, and you're getting the Roth features. In other words, no tax break up front, tax-free growth, tax-free distribution. Okay. Now, I think this would also be a good time to talk about conversions.
Okay.
So we do a lot of conversion analysis at our company, at Informed Family. We determine whether it makes sense to convert from a traditional account, a traditional IRA, or a traditional 401k, to a Roth IRA. So why would you do that? Well, because it may be to your advantage to pay your tax now on the conversion in exchange for that tax-free growth over the course of your lifetime. It's effective estate planning technique. Let's say you have money in your IRA account, you know you're never going to spend it. You're going to leave it to your family. It's going to be your legacy. Well, maybe you'd rather have a tax-free legacy than a taxable legacy. Maybe your tax bracket is lower than the tax bracket that your children are in. There's all kinds of reasons why you would do. Like, we have clients who aren't collecting your Social Security benefit yet. They're not working anymore, and therefore their taxable income is zero or it's very low. Well, in that case, we can do conversions, and maybe the conversions are only costing the taxpayer 10% or 15%. It's a very low amount. And if you've got cash, you got non-qualified assets laying around to pay that tax, that makes a lot of sense, and you're getting tax-free money with that conversion.
Okay. And so for both 401ks, 403bs, IRAs, how much money can you put into these on an annual basis? I mean, because it'd be nice just to say, I want to put $30,000 into a Roth.
Yeah, so if you're doing an IRA, it depends on your age. So if you're over 50, it's $6,500 per year. It's $5,500 plus a $1,000 catch-up provision for being old.
Okay.
So being old, I can say that because I qualify for that. I'm in that category. But if you're over 50, there's a catch-up provision of $1,000. So it's $6,500. So that's true for an IRA or a Roth IRA. Now, a 401k is different because a 401k, the rules are different as far as contributions, and it's like $24,000. That might not be the exact number, but in round numbers, it's pretty substantial. It's about $24,000 that you can deduct from your paycheck and put into a 401k. Now, one thing I didn't talk about yet, and I want to touch on it with regards to an IRA, is a SEP IRA. Because you asked me earlier about what you could do if you didn't have a 401k. SEP stands for Simplified Employee Pensions, SEP. So if you're self-employed, you can open up one of these SEP IRA accounts and contribute up to 25% of your income. So that's really something to consider if you're self-employed and you're looking to give yourself a little bit of a tax break, and you're also looking to save money for retirement. By the way, lost on all of our discussion today is the fact that these are all savings vehicles, and savings is critical, we believe, as you move into retirement, because you can never have enough money, right? We know that. You can't have enough money. So when you're retired, if you're getting Social Security from the government and you're getting a pension, which there's not as many pensions around as there were even a generation ago. So you have to take control of your own destiny, and the way you do that is with a lot of these savings vehicles that we were talking about today.
And what upcoming events do you have at Informed Family?
Well, we take the show on the road, so we're not just a studio band. We take the show on the road. So we're going to be at the Franconia restaurant in Franconia, Tuesday, March 13th. So that workshop, we are focusing on Social Security. So Social Security is a hot topic.
Yep.
It's a complicated topic. We've spent a lot of time on this show talking about Social Security. So those workshops are for people that are at or near the retirement age, Social Security age. So if you are interested in coming out to one of our events, please give us a call. We can give you tickets. Our number's up on the screen. You can send us an email, and we'd be happy to get you tickets. Make sure you call us call us in advance so that we can reserve a seat for you.
Well, that was a lot of information today. Great stuff. And thanks, Jeff, with Financially Speaking with Jeff Bush.
Yeah.
And
Yeah, so we covered a lot of ground today, and these retirement accounts are tricky. Okay. Another point I want to make, which is timely here, is the fact that you have until April the 15th to make a contribution for last year. So think of it as the deadline for your tax return.
Yep.
When do you have to file your tax return? April 15th. When do you have, what's the deadline for making a contribution for last year into your IRA? April 15th. So there's still time, and if you're looking for that last minute deduction, or you want to, you want to make an investment, now's a good time. And this, we're busy right now because we're dealing with people that want to do exactly that. So April 15th is the deadline. And if you need us to help you, don't hesitate to give us a call. Again, this is Financially Speaking with Jeff Bush.